If you have ever looked at a stock and thought, no, it's too expensive, then I have a bad news for you. You might have just cost yourself a fortune. So, hello everyone, I am Tamandip and you already know what you're watching, so let's get into it. If you have followed high PE equals to overpriced in the last decade, then you might have missed out on some of the best bull runs in history. Today we are going to break down why PE ratio is one of the most misunderstood metrics in the finance and how to actually find winners. So let's start with basics. PE ratio, price to earning ratio, is one of the simplest matrices in finance. It tells you how much an investor is willing to pay per unit profit, and therefore it is believed that low PE is a bargain and high PE is a bubble. But PE ratio is a rear view mirror. It tells us what happened in the last year. But stock market only cares about the future. But why would any investor pay a premium for a stock? The growth engine. See, a company growing at a 50% rate deserves a higher multiplier than a utility company growing at 2 or 3%. So, an investor is paying for future explosion in profit. In PE ratio, if E, the earnings, become double, then a high PE would become a bargain, won't it? And next point would be low interest rates. See, when interest rates go down, money becomes cheap and investors can no longer yield from bonds. So they pile up in stocks, increasing the PE ratio across the board. And third is quality. Think in terms of cars. Honda is cheap, Porsche is expensive. They both take you to work, but one has a better engine, better branding, and better resale value. Big names like Apple, Microsoft often carry quality premium because they have big moats, and that makes them a safer bet. I am not saying that high PE is good. That's how you end up on the road. You need to look for divergence. If the PE is rising but the revenue growth is slowing, then that's a red flag. If a company is getting into massive debts just to buy back its stock and artificially increase the EPS, earning per share, then you need to run. Stop being an amateur and start using two matrices. The first is PEG ratio. It is PE divided by the growth rate. Think a company's PE is 40, but it is also growing by 40%. Then the PEG ratio comes out to be 1. That is a fair price. Next is the forward PE. So this calculates based on the estimated earnings of next year. This is not always accurate. Nevertheless, it's a good indicator of where the stock might go. But be clear, it's not always accurate. The bottom line is high PE is not a stop sign, it's a yield sign. It tells you to slow down and look at the industry, the growth, the cash flow. See all this before you make a move, and don't let a single number scare you out of a great company. So that's it for today. I am Tamandip and see you later. Bye.